Welcome back, financial friends, to Am I Catching a Falling Knife, the podcast where we dig into the stories behind the ticker symbols and try to figure out if that stock dropping like a stone is a bargain or a disaster waiting to happen. Today, we're putting pharmaceutical giant Novo Nordisk, NVO, under the microscope. It's 20% down pre-market today, and there's a compelling narrative bubbling beneath the surface that makes us wonder, is NVO about to take a bigger tumble, or is this just a momentary blip for a fundamentally strong company? All right, let's dive into Novo Nordisk, ticker NVO. The market narrative driving NVO right now is centered on a downgraded 2025 financial outlook. Why? Intense competition is heating up in the GLP-1 obesity and diabetes markets, primarily from Eli Lilly, and their superstar drug Wegovy isn't penetrating the market as fast as expected. To add to that, NVO recently faced a U.S. patent defeat for Wegovy against Viatris, which is certainly not helping things. So, is this a dip, or is the knife still falling? First, let's get to know Novo Nordisk. NVO is a leading global healthcare company headquartered in Denmark, a true powerhouse in pioneering scientific breakthroughs. Their core focus is on serious chronic diseases, especially diabetes and obesity care, which, by the way, makes up a whopping 93.6% of their total company revenue. The remaining 6.4% comes from their rare disease segment. They serve millions worldwide and are constantly expanding their manufacturing to meet demand. Now, about that narrative's punch to the bottom line. How does increased competition and slower sales impact a company like NVO? This is where it gets interesting and, frankly, a bit painful for shareholders. The market's concerns, those specific headwinds like Eli Lilly's competition, slower Wegovy uptake, and that patent defeat, directly hit NVO's dominant GLP-1 portfolio within that massive 93.6% diabetes and obesity care segment. Our analysis estimates that these factors could lead to an approximately 6% reduction in the expected revenue from their GLP-1 portfolio for the upcoming quarter. When you consider that the GLP-1 drugs contribute roughly 70% of the revenue within that core diabetes and obesity care segment, which itself is nearly 94% of total company revenue, we're talking about the GLP-1 portfolio making up about 65.5% of NVO's entire revenue. So, a 6% hit to that 65.5% translates to an estimated 3.93% reduction in overall company revenue. And here's the kicker. NVO has a fantastic gross margin of over 84%, but that means they have significant operating leverage. Essentially, a small revenue drop can have a magnified impact on earnings. Applying an estimated operating leverage multiplier of about 2x, meaning a 1% revenue drop could translate to a 2% earnings drop, we're looking at an approximately 7.86% hit to quarterly earnings, which we're rounding to about an 8% negative impact. Now, I've got to be transparent. Our confidence interval on this is a bit wide, ranging from a 5% to an 11% hit, because getting exact figures on the degree of slower penetration or the precise financial impact of the patent defeat isn't publicly available. We're working with the best estimates we can make. So, with this narrative in mind, what's NVO truly worth? To figure this out, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. This model assumes a long-term growth rate of about 18.63% and a discount rate of 9.5%, which basically represents the return an investor would expect. Our base case DCF value, before accounting for the recent headwinds, comes out to around $95.21 per share. But when we apply the negative impact of our narrative, that 8% earnings hit we just talked about, the DCF value drops to approximately $84.74. The second method is a bit simpler, a PEG-based valuation. PEG stands for price earnings to growth, and it gives us a quick snapshot of how a stock's price relates to its earnings growth. Based on NVO's numbers, the peg-based fair value comes in at roughly $94.17. So you can see, even with the narrative's impact, both valuations are still above the current trading price of around 69, indicating potential upside, but the narrative case brings it closer. Now, for those thinking about catching this potential knife, where might you consider stepping in? Based on a more conservative approach and factoring in significant downside scenarios, some custom buy levels I've noted are $50, $40, and even $35. These are levels that suggest a much larger margin of safety should the market narrative worsen or the earnings impact be more severe than currently estimated. Remember, patience is key, and identifying your entry points is crucial in volatile markets. So, to wrap things up on NVO, as always, folks, remember, this is not financial advice. I'm just here to break down the complexities for you. Do your own thorough research, consult with a financial advisor, and make decisions that are right for your unique financial situation. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.